Hello and welcome. Today we will examine the macroeconomics of tax law. Our agenda for today will be what is macroeconomics and the broad definition of macroeconomics. What are Federal Income Tax and Job Act of 2017? What is gross national product and its variables? Gross national income, its equations and components. A broad overview of gross national product, gross domestic product and national income and how estimate and calculate them. What is the influence of the Federal Income Tax Act of 2017 on gross national product, gross domestic product and national income? Then we will discuss the influence of decrease in tax on unemployment rate and on corporate profits. And then the summary at the end will be conclude today's learning. Microeconomics is the examination or study of the behavior of national and regional economy. It helps to understand economic events like the total amount of production of goods, services, unemployment, and price behavior. Macroeconomics focus on large aspects of economy like inflation, that is an increase in the economy's average cost of goods and services over time. Economic growth rate, a percent change in the cost of the output of goods and services relative to the previous comparative period. Price level, variation in existing price for economical produced services and goods like the cost of goods, services and security. Gross domestic product, also called GDP, a quantitative measure of the market value of all finished goods and services produced in a given period. National income. National income is an aggregate amount of money generated within a nation. Unemployment level. The rate of unemployment is a percentage measure of the unemployed share of workforce within the nation. Macroeconomics factor can be positive, negative and neutral. Positive means any development that leads to rise in demand for goods or services is considered a positive factor. It ultimately stimulates economic stability and the expansion of the nation's business. Negative factor are threat to the national economy. It can lead to a political uncertainty, nation in a civil or global conflict, or a pandemic like COVID-19. Neutral factors do not have any positive or negative effect on the economy. Some economic changes and the consequences of those economic changes are the same as expected. Tax law are also called the revenue laws, are legal rules and regulations defining local, state and federal government taxes in the percentage of earning and non-earned income. It also includes interest, penalties, procedures and policies to implement related to the taxes. Federal Income Tax and Job Act of 2017 is also called the Tax Cuts and Job Act TCJA, passed by Congress in December 2017. It makes significant changes in deduction, depreciation, expensing, tax credits, and other tax items affecting businesses. The Tax Cuts and Job Act shift large amount of corporate tax of U.S. domestic businesses to U.S. multinational businesses. It was built on the idea to lower business and corporate tax rates, new domestic investment incentives, and protection against international profit shifting. Increase in investments make increase domestic workers' productivity and raise ultimate output and wages. The primary purpose of the Tax Cut and Job Act is to lower tax rate across income levels to reduce the income tax burden on the United States public. The Tax Cut of Job Act, Provision 11011 Section 199A allows sole proprietors, partnerships, LLCs, S corporations, and some trusts and estates to deduct income from qualified trade or business. Qualified business income is the net amount of income, gain, deduction, and loss from qualified trade of business, also known as pass-through income. Section 199A deduction has two main components. The first one is qualified business income component that allows qualified business income deduction equals to 20% depending on taxable income for domestic businesses. The C corporations are not eligible for these type of deductions. The second component is REITF PPT component, which allows deduction equal to 20% on combined qualified real estate investment trust earned through dividends and publicly traded partnerships income and losses. Gross national product is also known as gross national income, is a mathematical and statistical measure of nation's economic output. Gross national product is a market value of all nations' citizens earning domestically and internationally. It is the total market value during a specific period of time of final goods and services produced by nation's economy. Variables are the values that continuously changes over time in a given period. Gross national product variables are consumption, investments, government spending, net exports and net foreign income. The formula to calculate gross national product through its variable is Y that assumes as gross national product, also called GNP, equal to the addition of C consumption, I investment, G government spending, X as net export means export minus imports, Z as net foreign income calculated by net income from domestic residents from overseas investments minus net income earned by foreign residents from domestic investments. Consumer spending is a significant and largest component of gross national product. Consumption is a private expenditure on which consumer spends money to acquire goods or services. It includes spending on durable goods, non-durable goods, and services. Durable goods are items and products with the lifespan of more than 3 years, like automobiles and appliances. Non-durable goods are items and products with a lifespan of fewer than 3 years, like clothes and foods. Services are the action performed by businesses or individuals in exchange for a fee, such as tax preparation fee and medical cares. Investment spending is the second important component of gross national product. Investment in gross national product means business investment. It is an expenditure of capital by investors to conduct business activities by establishing economic organization. It includes the expenditure on residential constructions, business equipments, and inventories. Residential construction spending can be in the form of new home construction and renovation of existing homes. Business equipment can be purchased on new or old machinery and tool by the business. Business equipment is a tangible long-term asset for the benefits of the business over several years. Inventory spending means the stock of goods held by business for the use in future. It can be finished goods or services ready for sale or in the process of production or as raw material. Government spending is the money spent by the public sector for the acquisition of goods and provisions of services like healthcare, defense, education, or social protection. The primary source of government spending is direct or indirect taxes. The taxpayer direct taxes directly pay to the government, and taxes paid through the intermediary like manufacturers or service providers to the government are indirect taxes in the form of sales tax, service tax, and excise tax. In government borrowing, government borrow from its citizens and foreigners. Government spending can be current spending like wages and raw materials or long-term capital spending toward the nation's infrastructure. The purpose of government spending is to supply goods and services that are not provided by private sector, such as roads, defense, schools, and welfare benefits. Net export is a measure of the nation's total trade. It can be calculated by the total export values minus the total import values. Total export values are the amount of money a nation generates from its produced goods and services in the foreign market, and total import values is the amount of money a nation spends on services and goods received from the other countries. Net foreign income in a gross national product is an income earned by domestic residents from overseas investments minus income earned by the foreign residents from domestic investments. Consumption in the gross national product can be calculated by multiplying the marginal propensity to consume by disposable income. It has three primary factors to estimate. Consumption can be estimated by autonomous consumption, also called essential spending that will occur even without income, such as food, housing, clothes. Marginal propensity to consume assumes that consumption does not increase at the same rate as income. When income increases, people spend some and save the rest. Marginal propensity to consume is a portion of additional income spending by consumer with an increase in their income. Disposable income is an income that a consumer has in hand to spend after paying taxes. Investment is everything that remains after the total expenditure of consumption. Investment can be estimated by adding I. Investment, C. Business expenditures for machines, tools, lands and buildings, CI. Inventory changes held by the business. Government spending can be estimated by adding government consumption and government investments. Government consumption is the purchase of goods and services such as salaries. Government investment is the spending by government to acquire the goods and services for the future use, such as railroads and factory constructions. Net export can be estimated by subtracting the value of imports from the value of exports. The formula to calculate net export is equal to export of goods plus export of services minus import of goods minus import of services. Net foreign income can be calculated by subtracting net domestic citizen earning from overseas investment called NDI and net earning by foreign citizens from the nation called EEI. There will be automatic changes in the variables of gross national product with changes in the government tax policies. The first one is the consumer spending. The government tax policies directly hit consumer spendings. For example, reducing the tax will raise the income of individuals and businesses. Consumer will have more money to spend with additional income. The gross national product will increase as consumer spending increases. The high taxes will lead to less income for the consumer to spend and it will lead gross income product to decrease. High tax reduces the income that can be invested. Government tax policy to lower the tax rate will provide more investment opportunities for individuals and businesses. More investment means earning high in return. Earning high return will lead more to invest again and gross national product will increase. Similarly, higher taxes will result in less investment and negatively affect gross national product. The lower tax rate will increase the spending of consumer and investors. The demand will increase for both import and export. The governmental policy for lowering domestic taxes will increase demand for domestic goods and services and the nation's export. It will positively impact the gross national product. The tax cut will boost disposable income and encourages consumers to spend more and businesses to hire and invest more. It will make increase in national product. Tax increase will reduce disposable income and negatively affect the gross national product. Gross domestic product is a measure of market value of a nation's finished goods and services during a specific period. The United States gross domestic product measures the value of final goods and services produced within the United States. It includes consumer spending, business spending, government spending, and net export. There are two approaches to measure the United States gross domestic product. The first one is expenditure approach. It calculates the nation's gross domestic product by foreign aggregate expenditure. Number 1, consumption by households. Number 2, investment by businesses. Number 3, government spending on goods and services. Number 4, net export that can be calculated by export minus imports. The second approach is income approach that calculates the gross domestic product by adding the total national income, sales tax, depreciation and net foreign income. Total national income, also known as gross national income, that is total amount of money earned by the nation's businesses and individuals. Sales tax applies to the consumer to purchase goods and services and to the businesses on the sales of goods and services. It is a type of consumption on spending money. Depreciation is a decrease in the monetary value of an asset over time due to use, wear and tear. Depreciation can be calculated with the straight line method by subtracting the salvage value. Salvage value is the expected monetary value of the asset at the end of its useful life. Net foreign income is the difference between the income earned by the nation's domestic residents and income paid to the nation's non-residents. National income is an aggregate earning gross of national products. National product is the value of all goods and services produced in the nation. Therefore, national income and national product are always equal. There are two different ways to calculate national income, that are product method and income method. Product method called value added or value addition by subtracting the value of output minus intermediate consumption. Income method used to calculate the national income by adding household consumption, government spending, investment and net exports. The national income can also be calculated by adding cost and profits. National income is equal to cost plus profits. Consumption is equal to consumption of fixed capital plus net income payments to the rest of the world plus statistical discrepancies. National income measures the nation's total economic growth, including income and taxes earned at domestic and international levels. National income can be calculated by the WTS equation, where W is spending by the consumer, investment and governments, T is net export, that is export minus import, S is net foreign factor income. Government taxes changes make a significant influence on these variables. For example, lowering the tax generates more disposable income for individuals and businesses, and it leads to more spending. Spending increase will make an increase in import and exports. On the other hand, a tax increase will have a reverse effect on these variables. An increase in wages and decrease in taxes will make a positive impact on gross national product. With increased income, consumer will have more money to spend after fulfilling their essential needs. The increased wages will facilitate consumer to have more money in their hands and boost their spending for purchasing more goods and services. An increase in quantity and quality of the economic goods and services for the society to produce and consumer will lead to the economic growth. More spending increases demand, and demand generates more production. Therefore, an increase in income and decrease in tax will lead to the more economic growth. Disposable income is an available income to spend or save after deducting taxes and mandatory expenses. The availability of disposable income will encourage consumers and businesses to spend more on investment to gain more returns on those investments. Investment is an asset or item to acquire with the objective to generate more income or appreciation. The increased value of an asset or item over time is called appreciation. More income and a decrease in tax will lead more investors to invest in creating wealth for the future. Income increase or decrease in tax will increase the purchasing power of domestic citizens. The domestic demand for consumption will increase and it will increase domestic production. Therefore, it will positively affect the gross national product of the nation. The tax rate by the Tax Cuts and Jobs Act (TCJA) of 2017 significantly and continuously reduced the US private unemployment rate. The US unemployment rate was 4.9% in the first quarter of 2016 and remained the same in the second quarter of 2016. It reduced by 0.1% in the third quarter of 2016 and further declined by 0.2% in the fourth quarter of 2016. In 2017, it further declined by 0.1% in the first quarter, 0.2% in the second quarter, and 0.1% in the third quarter, and 0.1% in the fourth quarter of 2017. The unemployment rate at the end of the fourth quarter of 2017 was 4.2%. Cutting or decreasing tax is a standard method that government uses to increase economic growth and reduce unemployment. A decrease in taxes puts more money into the hands of consumers, leading to increased demand of consumers and increased demand leading to businesses to generate more revenue. It further increases the demand for businesses to expand and hire more employees. Hiring more employees reduces the unemployment rate of the nation. The US private unemployment was reduced to 3.8% by the end of the fourth quarter of 2018. It reduces by 0.2% from the fourth quarter of 2017 to the first quarter of 2018, 0.1% in the second quarter of 2018, 0.1% in the third quarter of 2018, and remains the same at 3.8% at the end of the fourth quarter of 2018. The Tax Cuts and Jobs Act (TCJA) positively impacted corporate profit reported in the United States. The total corporate profit reported in the United States at the end of the fourth quarter of 2006 was 2.072 trillion US dollars. It increased significantly by the end of the fourth quarter of 2018 by 0.335 trillion US dollars and reached 2.395 trillion US dollars. The corporate profit increased in each quarter with the immediate effect of decrease in tax and increase in consumer spending for domestic products. The flat reduced rate of 21% of the corporation saves money and encourages the corporation to expand their products and services to generate more revenue by investing. The tax cut also gives the power to the consumer to spend more money and encourages them to invest, leading to boost in the economy. More demand, more production, and more expansion boosts the corporate revenue. The Tax Cuts and Jobs Act encourages U.S. domestic businesses to return an overseas profit to the United States and reinvest that profit into the domestic production to fulfill the increased demand of domestic consumers. Increased investment increases the revenue and stimulates the future wealth of the businesses. It provides confidence and secure feeling to reinvest more in domestic productions. The Federal Income Tax Act of 2017 was passed with the idea of lowering the corporate taxes to increase domestic investments and provide protection to domestic businesses from shifting international profit, decreasing unemployment and boosting the nation's economy. It has made a positive impact on gross national product and national income with increased spending by consumers. It increases the disposable income for both individuals and businesses. More disposable income generated more demand for consumer consumption. Consumer consumption demands more products of goods and services. Goods and services demands lead the businesses to expand or hire more employees. Business expansion generates more revenue and hiring more employees by businesses reduces the unemployment rate. More revenue of the businesses and consumers encourages them to invest more. Investment increases wealth for future use. Domestic investment increases the demand for more domestic products and services that generates more export from the nation. Increased revenue leads to more taxable income and it leads to generate more government tax revenue. Increased government revenue creates more infrastructure for the convenience of the nation's public. All the variables, consumer spending, business investment, net export, government spending, and net foreign income positively impacted the gross national product, gross domestic product, and national income. To take a deep dive and dig in more details for this study, please follow the references. Thank you for your time today.